Good afternoon, everybody, and welcome to this first meeting and press briefing of the Monetary Policy Committee for 2011. Since the previous meeting of the Monetary Policy Committee, there have been more convincing signs that the recovery in the global economy can be sustained. However, growth in the advanced economies is expected to slow and is subject to a number of downside risks, including the sovereign debt crisis that continues to beset the Eurozone. The more promising global growth outlook, as well as the unfavorable weather conditions, has implications for commodity prices, particularly those of food and energy. These pressures are likely to pose an increasing risk to both the global and domestic inflation outlook. Nevertheless, domestic inflation is expected to remain within the target range for the forecast period. Domestically, the output gap remains negative, and GDP growth is expected to remain below potential over the next 2 years. However, there are indications that the outlook for output growth, while hesitant, is somewhat more positive. The recovery in household consumption expenditure appears to be sustained. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, moderated to 3.5% in December from 3.6% in November 2010. The average inflation rate for 2010 was 4.3% compared with 7.1% in 2009. That is slightly below the midpoint of the inflation targeting band. Food price inflation in December measured 1.4%, unchanged on a month-on-month basis. The main contributor to the inflation outcome remained housing and utilities, primarily electricity, which contributed 1.5 percentage points to the 3.5% outcome. Administered prices, excluding petrol, increased at a rate of 9.1% in both November and December. Year-on-year PPI reached a recent peak of 9.4% in June 2010 and has declined moderately since then. In November, the PPI increased by 6.2% compared with 6.4% the previous month. The impact of the exchange rate on producer prices is still clearly evident, with the prices of imported commodities increasing at a year-on-year rate of 0.5%. Manufactured fruit prices increased by 0.6%, while agricultural prices declined by 0.3%. The CPI forecast of the bank has been revised upwards since the previous meeting of the Monetary Policy Committee. Nevertheless, the domestic inflation trajectory is still expected to remain within the target range over the entire forecast period to the end of 2012. Inflation is now expected to average 4.6% in 2011 and 5.3% in 2012. The upward adjustment is mainly due to revised assumptions on the international oil price over the forecast period, and we will continue to monitor global inflation trends closely. The bank's forecast is very similar to the consensus forecast. In the December survey, the mean forecast of CPI inflation, this is the Reuters forecast, was 4.5% for 2011 and 5.4% and 5.6% for 2012 and 2013, respectively. These forecasts were slightly higher than those of the November survey. The break-even inflation rates across all maturities also continue to reflect inflation expectations within the target range. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the fourth quarter of 2010, continue to trend downwards. For the first time, average expectations for 2011 are within the inflation target band at 5.5%. The expectations of all categories of respondents declined, with both business executives and trade union officials expecting inflation to average 6%, while those of the financial analysts declined to 4.5%. All categories of respondents expect inflation to increase again in 2012, when it is expected to average 6.2%. The global economic outlook remains uncertain, but there appears to be increasing optimism that the recovery, albeit relatively weak, will be sustained. Most forecasts have been revised upwards in recent months, but indicate that global growth is expected to be slower in 2011 than in 2010. However, the prospects remain uneven across countries and regions, and a number of risks remain. Growth in the US continues to be supported by strong monetary and fiscal intervention, while growth in Japan remains subdued. In the euro area, the recovery is being driven by strong growth in Germany, but this is expected to moderate in 2011. In the rest of the euro area, confidence has declined in the wake of the worsening sovereign debt crisis, which remains a major risk to the outlook. Recent coordinated measures appear to have stabilized the sovereign debt markets for now, but significant risks remain, and a further escalation of the crisis could impact negatively on global growth prospects. The emerging markets continue to outperform the advanced economies, with strong recoveries in consumption and investment in the major emerging market economies. Inflation developments and prospects also appear to reflect the divergent growth trends. Persistent large negative output gaps in the advanced economies have helped to contain inflation pressures, despite rising international oil and food prices. There is still some risk of deflation in the US, although this risk is declining. By contrast, inflation in the emerging markets has been increasing, partly as a result of stronger demand pressures, but also as a result of the higher weights of energy and food in the consumer price baskets. These trends have resulted in generally tighter monetary policies in emerging markets, but monetary accommodation is expected to persist in most of the major industrialized countries for some time to come. The exchange rate of the rand has been relatively volatile since the previous meeting of the MPC, when it was around 7 rand against the US dollar. By early January, the rand had appreciated to 6.55 rand, but has since retraced to levels prevailing at the time of the previous meeting. During the period, non-residents became net sellers of rand-denominated bonds, as expectations that there would be further interest rate reductions were reversed, but were net buyers of domestic equities. Factors influencing the exchange rate during this period included developments in the euro-dollar exchange rate, further acceleration in commodity prices, and persistent capital flows to emerging markets. In the absence of general risk aversion or a tightening of monetary policy stances in the advanced economies, the rand exchange rate is expected to remain relatively strong. Since the previous meeting of the MPC, the nominal effective exchange rate of the rand depreciated by 0.4%. During 2010, total direct foreign exchange reserve accumulation by the Bank of the National Treasury amounted to $7.4 billion, or a spend of just over 53 billion rand. Despite this, the rand continued to appreciate and remain strong. Continue to appreciate that, for instance, 12% against the US dollar during 2010 and remained strong. Portfolio and foreign direct investment inflows continued, and the net purchase of bonds and equities by residents amounted to 89.5 billion in 2010. The bank will continue to accumulate foreign reserves as and when possible. Domestic GDP growth remains subdued, with growth of 2.6% in the third quarter of 2010. Although there are mixed signals about the sustainability of output recovery, high-frequency data indicate a stronger fourth quarter performance, and forecasts for 2011 have generally been subject to moderate upward revisions. The bank's forecast was also adjusted marginally, and growth is now expected to average 3.4% in 2011. The forecast for 2012 is unchanged at 3.6%. The composite leading business cycle indicator of the bank has been relatively flat in the past few months and declined moderately in October, reflecting the uneven growth prospects. Gross domestic fixed capital formation is still subdued, having increased by 0.9% in the third quarter of 2010. This rate of investment growth remains too low to meaningfully impact on output growth and is currently primarily dependent on the state-owned enterprises' pipeline commitment to infrastructure, while investment in the manufacturing sector is being constrained by low levels of capacity utilization. The labor market appears to have stabilized in the third quarter, when employment levels were more or less unchanged, although unemployment remains stubbornly high at 25.3%. The recovery in the manufacturing sector remains hesitant. Manufacturing output increased by 4.6% on a year-on-year basis in November, compared with 2.3% in October. Production of motor vehicles, parts, and accessories in particular have exhibited robust growth, including vehicle exports, which increased by 52.8% quarter-on-quarter in the final quarter of 2010. The Kagiso Purchasing Managers Index, the PMI, confirms this uncertain outlook. Following a strong improvement in the index in November to a level in excess of the neutral 50, it declined again in December, although still indicating an expansion of the sector. The mining sector has also been improving and grew at a year-on-year rate of 9.6% in November. The RMB BER Business Confidence Indicator remained relatively unchanged throughout 2010, but with a negative outlook. The recovery in domestic consumption expenditure appears to be sustained. Real final consumption expenditure by households increased at an annualized rate of 5.9% in the third quarter of 2010. Strong expenditure growth was observed in all components of consumption. Real retail sales increased at a year-on-year rate of 7.8% in November 2010. New vehicle sales continued their strong performance, having increased by almost 30% in December. Consumer confidence, as reflected in the FNB BER Consumer Confidence Index, has been at a relatively high level during the past year. Credit extension maintained its moderate upward trend during 2010. Total loans and advances to the private sector increased by 4.4% in November. Growth over 12 months in mortgage advances has fluctuated around 4.8% since August 2010, reflecting a loss of momentum in the real estate market. House prices increased somewhat in the first half of 2010, but since then the rate of increase has declined, with some house price indexes indicating that prices have been falling. Growth in installment sales and leasing finance and other loans and advances maintained a positive trend. Within the latter category, growth in credit card advances were positive for the first time since the end of 2008. Bank overdrafts were the only major category that continued to contract, although at a slower rate. Household debt remains high at 78.5% of disposable income. However, lower interest rates have reduced the ratio of debt service cost to disposable income to 7.8%, compared with 12.6% in the third quarter of 2008. Expenditure has been positively affected by growth in real disposable income, lower interest rates, and some favorable wealth effects. Share prices on the JSE have reached levels in line with the peaks reached before the onset of the global financial crisis. In 2010, the all-share index increased by 16.1%. Risks to the inflation outlook emanating from global commodity price increases have become more evident. These risks relate mainly to oil and food price developments. Having fluctuated in the range of $70 to 80 per barrel for much of 2010, the price of Brent crude oil began to increase in late November and is currently at around $98 per barrel. The surge in oil prices is due in part to stronger global oil demand and the exceptionally cold weather in the Northern Hemisphere. These price trends were also affected by US dollar developments, particularly following the announcement of additional quantitative easing by the US Federal Reserve in November. The domestic petrol price, which has been cushioned to some extent by exchange rate developments, has increased by 66 cents per litre since the September 2010, and by 11% over the past year. Since September, the Rand exchange rate has offset the petrol price increase by a cumulative 45 cents per litre. Global food prices have also continued to increase, driven by tight food supplies, changing weather patterns, and rising demand in emerging market economies. To date, South Africa has been shielded to some degree from these increases by the exchange rate and the bumper maize crop. Domestic maize prices have been increasing since the middle of 2010, but in January this year were still about 11% lower than a year ago. By contrast, South Africa is a net importer of wheat, which has increased in price by almost 40% over the past year. Although producer price developments suggest that domestic food price inflation will remain low in the short term, these global developments, unless reversed, will inevitably impact on consumer price inflation. Administered prices and wage settlements remain upside risks to the inflation outlook. Although wage increases have moderated slightly over the past months, they are still significantly in excess of the current and expected inflation outcomes. According to Stats South Africa, the year-on-year rate of increase in average nominal remuneration per worker in the formal, non-agricultural sector declined from 15.8% in the second quarter of 2010 to 12.6% in the third quarter. Once labour productivity developments are accounted for, unit labour cost increases amounted to 10.9% and 9.3% in these two quarters, respectively. According to Andrew Levy employment publications, the average wage settlements in the first 9 months of 2010 amounted to 8.3%, compared with 9.3% in 2009. The current level of the repo rate is at its lowest level in nominal terms in over 30 years, while the real interest rate is at a level below 1%. This has helped with the recovery in consumption expenditure and should also stimulate domestic investment and growth by reducing the cost of borrowing. However, low interest rates on their own cannot ensure sustainably higher long-run trend growth and employment creation. The MPC has taken note of the improving outlook for the economy and is of the view that the recovery in domestic consumption expenditure will be sustained. While there are increasing risks to the inflation outlook, these emanate primarily from external cost push factors, and inflation is expected to remain within the target range until the end of the forecast period. The MPC has therefore decided to keep the repo rate unchanged at 5.5% per annum. At this stage, there are no signs of incipient excess demand in the economy, and unless there are significant unexpected changes in the global or domestic outlook, the monetary policy stance is expected to remain relatively stable for some time. The MPC will continue to monitor developments closely and stands ready to act should the need arise. Thank you. Open to any questions that you would like to make. Yes, sir.
Helmer Price, New Age. In terms of the new growth path, how does the Reserve Bank interact with that, Governor?
Well, obviously, the new growth path has a plan for the country, and I think it's extremely important that we have a document on the table that we can work to. As has been said, this is a work in progress. The interaction for us is what is our responsibility within that. And as you know, our responsibility is very clearly to ensure that we have an approach to containing inflation and to take account of what is happening in the real economy to the extent that there are responsibilities that we have as a central bank that we need to fulfill. So certainly in our discussions, we look at growth, and as we've seen, from a historical perspective, we did not include growth numbers in our reports. It was obviously part of discussions, but you can see in our outlooks we do give our numbers for growth, we do consider it, we do take account of what is happening in the real economy, what is happening in manufacturing, what is happening in terms of growth, development, jobs, employment, and within that context, what is happening in terms of our specific responsibilities. So we're very sensitive to what is happening in the real economy and the imperative of growth, and our contribution is ensuring the value of the money stays real and protects the poor, and tackling inflation, taking all of these other measures into account as well. Yes?
Kosi Tom from Summit TV. Governor, to what extent did the adverse development in the Eurozone affect the rate decision?
I think I've spelt that out, is that it doesn't affect our situation at this point in time, but there is no question that the sovereign debt crisis that prevails in Europe is a very big issue. It's a big issue for Europe, it's a big issue for the world. So it is something that we watch very closely and are confident that the measures being taken, the work of the central bank, the Financial Stability Board, the support that's required in terms of the relationships between the banking sector and the sovereigns and the US and its support in terms of dollar provisions, all of those factors are taking this into account, and you can see it's receiving the highest attention in the UK, in the Eurozone, and we watch that with a lot of concern. At the back.
Chris Bishop, CNBC Africa. How confident are you about your inflation projections bearing in mind the rapid rise of the oil price. I mean, just a couple of months ago it was $80 a barrel, now it's nearly 100. In another 2 months' time, who knows?
Well, exactly. The whole question of central banks is that you do deal with uncertainty looking forward. These are the best figures that we have at this point in time. Obviously, we do run different scenarios in terms of it depreciates or it depreciates in combination with other things. But at this point in time, as we've said, we see it as a real risk that could affect the outcome. But at this point in time, these are the numbers that we've had as I've spelled out. So certainly, the question of oil and the question of food inflation are very definitely risks that are emanating from the external into South Africa. Yes, sir.
Alistair Anderson, Business Day. Just regarding the risks, and I suppose that brings in a possibility of another cut in the future. Regarding wage increases, are you concerned about private sector wage increases this year, given the precedence of public sector wage increases last year?
Well, we've tried to indicate what the changes and increases have been, taking into account productivity. The question that there was something of a decline between 2009 and 2010 was helpful. But there's no doubt that if we want to get the growth levels that we need and the employment that we need, you need a combination and coordination of policy and actions. And, you know, for the question of increases, that is up to the labour movement and business to decide between them. But as we know, all of these factors need to be taken into account when you're looking at a priority of tackling unemployment. So the question South Africa needs to ask as well is why are we so ready to move to capital-intensive means of production, and to look at the whole question of, you know, the question of employment relates to so many things. It relates to education, it relates to growth, it relates to job opportunities, it relates to a conducive environment. So, as we have said, we think these are risks, but we are confident that in the outlook for the year going ahead, that everyone will take account of what needs to be done to ensure that we pick up the growth levels from where we are. Yeah.
Governor, hi, Renee Volgra from Sunday Times, Business Times. How big of a risk does the MPC think is the coming electricity rises this year? Because we are going to have a lot of increases in electricity prices again.
Well, I'm not quite sure if those are surprises. I think that the question of electricity increases, as far as I'm aware, is that it has been set over a number of years. It was put at, 25%, and I think that's the same expected for this year. There may well be a discussion, and I'm sure there is, between Eskom, NERSA, what is the finessing of it, but I think those have been built into the outlook for electricity increases because those are not unknown numbers. So this takes account. But what we've also indicated that in terms of the price, the CPI this year, the last month, was that electricity was a contributor. Administered prices as a whole is a contributor. Yeah.
Lauren Toast from Soccer 24. You would have probably seen the rand strengthening quite significantly, and you said that despite Reserve Bank and Treasury accumulation, the rand still appreciated. Will the bank continue to accumulate reserves even more aggressively, given the strong level of the rand currently?
As we said in the statement, we have a very clear commitment to increasing reserves as and when it's possible. As we gave you an indication that to accumulate the reserves that we did last year cost 53 billion rand. We're not talking about the profit and loss of the central bank. Though in my view, that's a lot of money. And if you've spent that amount of money and your rand is roughly where it was or it has appreciated, you have to weigh up what you're doing it for. So the question for us is quite clearly that we're looking at in terms of a continued steady build-up of reserves, but whether that would impact on the appreciation of the currency or a depreciation is a very moot question. I'm not sure if any of the countries that have intervened have been able to show their currency, the currency changes or depreciation as a result of that. Yes, sir.
Franz Wild from Bloomberg. Just coming back to the oil and food prices, I mean, what was your outlook on those when you made your inflation forecasts?
Would somebody else like to tackle that one? Brian?
I don't recall offhand the exact figures, but I think that as we indicated in the statement, there had been one of the reasons that our inflation forecast did increase over this year and next year is because of a change in the assumption relating to the administered prices, mainly to the oil price increases. If I remember correctly, the price of oil assumed for 2010 and 11 was, I think, in the region of $90 per barrel for 2011 and a bit higher for 2012. Obviously, if trends continue upwards, then there may have to be a revision of those assumptions in the future.
And as we said, is that we've done scenarios with various different levels. Those are the assumptions. Obviously, you've seen the oil price change, and we have to see where that actually goes to. I mean, it's a lot of discussion. If you look, there seems to be some increase in production from some of the oil-producing countries, offset by declines in others. And as I indicated, it's something we would watch very closely in that regard. You want a follow-up or a different question? Okay, we'll come back to you then. Who hasn't? You haven't asked.
Mpumzana Tanda from Reuters. You note in your statement, Governor, that the recovery in domestic consumption is you're expecting that to continue, and even though it's continuing, it's still rather sluggish. Are you saying that perhaps monetary stimulus so far has played its role and it's been sufficient?
You know, these things are not things that you want to pump into a consumer and say, we're going to make this something that you're simply going to roar ahead. I think that there needs to be while there is a question that we have done quite a lot, if you looked at it in terms of what it has done, particularly in reducing the cost of debt service for consumers. Ideally, South Africa, you want a much broader recovery, not just a consumer-led recovery. You certainly want to have your whole economy recovering, your manufacturing, your agriculture, everything to be growing together. So we would not necessarily look at it to say, is this enough or not enough? We think that measures have been taken. You're seeing a sustained response. But we would urge consumers that their real question must be to check their levels of indebtedness, their affordability going forward. All of those questions become extremely important. So it's not about whether it's enough or not. We would consider all the factors in taking that decision going forward. But at this point in time, it has certainly helped consumers. And we can see, or our view is that the recovery in the consumer is probably sustainable. But we would certainly urge that in that recovery, you don't increase your indebtedness. You know, the recognition has to be that if you're talking about oil prices, etc., you don't assume, just as you would have before, that this is something that there's steady state. Consumers really do need to look at their indebtedness and try to come out of it as much as possible. Let me see if there's anyone else who hasn't had. Come back to you, Helmut.
Governor, can you give us forecasts for the fourth quarter and for 2010 and annual GDP, and what is the estimate in terms of the output gap?
The output gap is 3.75 to 4%. The potential output. The question for us would also be in terms of the growth. Our estimate is slightly revised down, I think 2.7 for 2010. The outlook for the fourth quarter we're waiting to see, but obviously we hope that it would be in the ballpark that gives you that outcome. That is what we're looking at and our estimate there. We did give you the growth numbers that we anticipate for next year. I don't know if you want to add anything, Brian? Yeah.
Just going back to the exchange rate, Governor, when it comes to trying to weaken the rand, which one is more important and more effective to use? It buying more reserves or decreasing the interest rate?
What happened when we decreased the interest rate last time or the time before? Anything? Look, the question is the interest rate differential is important in terms of the flows in. And you can see that. If you look at our own, the question of what is happening in the advanced economy, the search for yield, what we're saying is that I don't think it's an either-or, and I'm not sure if you do both and to what degree you do. It does actually have any impact anyway. As we've indicated, we've bought reserves, we've lowered interest rates, and the rand has, in fact, appreciated 12% in the year to the dollar. So we've actually done a bit of both within our limits of affordability or what we think is prudent. So it's not just, you see, this isn't just a rand issue. This is a euro-dollar issue as well. It's what's happening in the exchange rate in the developed economies. It's looking for the search for yield. And if it's lower for longer there's going to be a continued search for return in emerging markets. You had a second question?
Yes. I wanted to ask you, some economists have already talked about the potential, the possibility of a rate increase in the second half of the year. Do you think that the economic recovery is strong enough to warrant that as a possibility at this stage?
I think that's a question that we're going to have to wait and see what we decide to do. The economists can always speculate. We look at it to take decisions, and I don't think that we predict about what we would do or not do. What we've indicated to you very clearly is the risks that the economy faces, both globally and domestically. As to what that would imply or when it would imply, what your rate decision is, I'm afraid you have to wait for each MPC.
Can I just ask the usual question, whether the rate decision was unanimous, and did anyone support a rate cut?
No, it was unanimous that we hold where we are. Yes?
Governor, you said interest rates on their own cannot sustain or cannot ensure sustainable longer-term growth and employment creation. What else is needed? What policy actions?
Who would like to tackle that one? XP?
There's a large range of these things, but essentially they focus not on the macro dimension, but on the micro elements. So you have to look in terms of aligning your skills development programs to the opportunities that exist. You have to look in terms of ensuring that the impediments to employment creation are reduced or eliminated. The whole gamut of issues, less to do with the macro environment, but much more to do with the micro. If you want us to go into that, we can go into it after this.
But an important part of that is the coordination, cohesion, sequencing. What enables you to have a looser monetary policy depends a lot on what happens at the micro level. So it is something, and as you've seen from the growth path and the discussions that have been held, that's the key focus of attention that government is addressing at this point in time. So it is that coordination, cohesion, sequencing that becomes extremely important in terms of all of those policies that would enable or create a more enabling environment for macroeconomic policy. I don't know if anyone wants to. I think there was, let's just see if there's other questions. Yep.
Just as a follow-up on that question, Pravin Gordon would like to get the country's view on how, or rather South Africans' view on how to achieve an economic growth rate of 7% over the next 20 years. And I just wanted to find out, what's your tip for the Minister?
I'll give it to him personally. Howard?
Governor, you've started using swap forex transactions from August, which run for 12 months. Are you considering establishing a sovereign wealth fund or other instruments once those 12 months come up?
Daniel?
Helmut, there's actually, they run up to 12 months, and when those longer dated effects are mature, the opportunity then exists either to roll them forward or to take delivery of the foreign exchange that would become due, and that will then obviously allow us to continue this program of increasing reserves. Issues around whether one establishes sovereign wealth fund or not are things that are related to the overall strategies around reserves management, and those are things that are periodically reviewed and decisions are taken as and when we move there.
You want to follow? Helmut?
Just a follow-up question then in terms of Basel III, the liquidity mismatch between short-dated instruments and long-dated instruments. How is that being addressed?
Well, perhaps I'll just respond to that one. Basel III has three areas that they're focusing on in terms of the Basel Committee for Banking Supervision and the reforms that are required. It's liquidity, it's leverage, and it is the capital adequacy. And I think it's important to look at all three in that regard as it affects the South African banking sector. Capital adequacy, don't forget this is quite a long-term horizon. They're looking at sort of measures by 2015, but absolutely by the end of 2018, so there's quite a long lead in. And in terms of capital adequacy, Tier 1, the Basel expectation is that it should be at 6%. Tier 1, 6%. Now, the South African banking sector is already at 11.5. If you look at total, this is by 2015 for the 6%. If you look at the total, they would be moving this to 8%, and our total is already at just over 14%. So in essence, the South African banking sector does not have to go out and raise capital. We already meet the capital requirements as envisaged for the global banking sector to move to by the end of this introductory period, end of 2018. As I said, with landmarks along the way for different things to come into place, but in general terms. If you look at leverage, there's a very big push by the Basel reform program to reduce leverage to 3%. That's got different calculations, but we are at half of what they would like it to be. So that again, in terms of leverage, our banks do not have to deleverage. Liquidity does pose a particular problem in that we have a structural savings rate location, and the way we save in South Africa does create that mismatch. And there is a working group between the National Treasury and the Reserve Bank and Bank Supervision Department to work on that. So in that sense, we are cognizant that this will need some structural change in the way we save in the economy. As part of that question, one of the things that the Basel Committee is also looking at is that its focus has been on the capital requirements. And therefore, over the next, until 2014-15, the next 2 or 3 years, a lot of research and work will be done by the committee and across the central banks across the world, will be to look at what the macroeconomic impact is of creating liquidity requirements and the different ratios that would be required, because there's not sufficient work that has been done on the macroeconomic impact. So this is very much work in progress, not just for South Africa, but for the whole question of liquidity ratios that will be imposed by Basel III.
In terms of that, will there be any need to do bank stress tests like they have done in the Eurozone or in the US?
Obviously, we've had different arrangements about what we're looking at in terms of what banks are required to do, but we have not had to do what they've done because they've got to look at the soundness of their banks and what's happening with their banks, and obviously we haven't had to do that. There have been also quantitative impact studies done by a number of banks, but we serve on the Basel Committee for Banking Supervision, and our commitment as part of the global banking sector is to be not just compliant because it needs to be compliant, but for the sake of soundness. So whatever we are required to do, we do. We don't have to do what they're doing because we don't have those problems. Yeah. Other questions? Okay.
Vanna, do you think that 7% growth is attainable over the next 5 years?
It depends what we do. There's absolutely no reason that other countries can grow at 7% and we can't, in the theory of it. If you looked at mid-2000s, we were, for a period of time, growing around 6%. So it's not that we can't attain it, but we can't attain it because we set it as a target. You've actually got to do a whole lot of things to get there. And if the commitment is, which I think is a very important commitment, to tackling unemployment in this country, then that is a target worth doing all we can to attain, because you're going to need growth levels that are much higher in order to address the significant unemployment that South Africa faces. But it needs this combination and coordination of policy, which I think is being set out at this point in time. So certainly worth striving for. Anyone else? Thank you all very much. Thanks for your questions. Thanks for being here. And I wish you everything of the best for 2011. And I'm sure we'll see you ongoing during the year. Thanks to the Monetary Policy team. Thank you.